Okay, last time, right, we have talked about how to build a mortgage calculator. And this week, we are going to show you how to build a home buying investment e-Analyzer by using numpy in Colab. Probably you have heard about NPV and IRR, right, representing the net present value and internal rate of return. They are usually calculated by using Excel worksheet, and here shows you an example. It is quite complicated. Here I simply show a 10 years rental income, and then usually we have to provide the discount rate, the loan interest rate, the home price, and the expense percentage. And also after 10 years investment, we have to provide an expected sale price at the end of year 10. If you are borrowing mortgage, then you also have to provide information about the down payment percentage of mortgage loan and also the mortgage interest rate and the repayment period. With all this information, then we build a table. Here shows you 3 cases. The first case is 100% loan and interest only repayment. In other words, in the end of year 10, you have to pay back the home price 100% to the bank. Then usually, right, it's quite tedious. You have to calculate the discounted cash flow by using the discount rate to bring future value back to present value. And more complicated is the calculation of the internal rate of return, IRR, which we have to use the what if function of Excel, which I have shown in another YouTube, which I put the link down below. Okay, so today we are not going to build an e-Analyzer by using numpy in Colab. So this one, right, is using numpy-financial's NPV and IRR function. So just as last time, we install the numpy-financial and also use numpy as NP and numpy-financial as NPF and import NPV and IRR function. So I do not repeat because last time we have already demonstrated how to build these sliders and in data input routine here, I simply make use of the slider for the discount rate and the loan rate. Then we enter the home price, 1 million, and then the expected weekly rent in the first year, second years, up to 10 years. Also, we have to tell the percentage of expense rate. Say, for example, management fee, tax, stamp duty, rates, and maintenance fee, etc. Here I simply put 15%. Then we also provide an expected sale price at the end of year 10. So it is a 10-year investment horizon. We are going to compare 3 cases scenario. The first one is 100% loans and assume a simple interest and a repayment. Then in numpy, first of all, we have to define the annual net rental income. So by means of the weekly rent times 52 becomes yearly rent, and we assume that it requires 15% of the rental incomes to pay for management, rates, and maintenance. Then, of course, we would also deduct the yearly loan repayment based on a simple interest calculation as the first line, right? We calculate the yearly loan interest repayment as the home price times the loan rate. Here I print them out so that you can take a look that each year for 1 million house price for 4% simple interest. So every year you have to pay $40,000 as interest, and it results in negative net rental income. Here I simply make use of the numpy-R rate to input the 10 years cash flow. I define as CF, the cash flow of case 1, C1. So without initial payment, so the first R rate is 0, and then every year we have the net rental income. In this case, is negative, and in the end of the 10th year, we will include the expected sale price in the end of year 10. But we have to minus the repayment of 100% home price to the bank. So then we make use of the numpy NPF.NPV function. It simply requires the discount rate and the cash flow. And it will calculate the NPV. I print it out into decimal place. And also it provides IRR function, which simply required just one parameter, that's the cash. So here you will find that in this scenario, case 1, the net present value NPV is about 6,700 something. That means, right, the internal rate of return 6.13% comes quite close to the discount rate and the loan rate, so it's not very attractive. Okay, then let's take a look about case 2. Case 2 is 100% saving. That means you do not borrow any cents. You can buy it by yourself. Okay, so we define net rental income yearly in case 2, which do not deduct the annual interest payment because you do not borrow. Then we also repeat the cash flow our way here, but for the first initial payment would be the home price in negative term because you paid 100% by your own. But in the end of the 10th year, you simply add the expected sale price without deducting the repayment of home price because you do not borrow. Okay, let's take a look about the difference. And here you will find that, wow, the net present value becomes very negative, and the internal rate of return is just 4.16%, even less than the loan rate. So you will find that if you pay by your own, because of the high loan rate in this scenario, then opportunity or this investment method make a lower internal rate of return. Then how about case 3, which is the most typical one, by borrowing 80% from bank's mortgage package, and you have to pay 20% down payment. So let's say mortgage rate is much lower, just require 2.55%, and the repayment period is also 10 years. So that after 10 years, you have paid back everything to the bank and you can sell. So similarly, we define yearly net rental income, but this time we will deduct the PMT. Probably you still remember last time we have made use of PMT functions to build a mortgage calculator, which require the mortgage rate, repayment period, and the loan amount to identify the monthly repayment amount. Then we times 12 will equal to the yearly repayment amount. And similarly, we define the cash flow in this case 3. You paid 20% down payment. That is the home price minus mortgage loan. And in the end, because you have paid back 100%, mortgage to the bank in the end of the 10th year. So you simply add the expected sale price. Okay, let's take a look. What would be the NPV and IRR in this case? Or it's positive 29,000 something, and the internal rate of return is 5.66. So here is a comparison of the three cases, case 1, 2, and 3, and the initial cash flow of the three cases. For the first case, you borrow 100% from the bank, so you do not have any cash outflow. For the second case, you pay 100% by your own savings, so the initial cash flow is negative 1 million. But for case 3, you just paid 200,000 as down payment. And then you will find that even though for case 2, the net rental income will be positive because you do not have to pay back any loan, but the final cash flow in the end will be much bigger in case 2, but still case 2 is not the best case because of the discounting effect. And the third case here, even though it's negative net rental income, but because in the end, the investors can get back 100% of the resale price, provided that house price goes up, then case 3 will get a positive net present value.